Hey everyone, welcome to The Explainer. I am so pumped to have you here today because we're tackling something that is honestly one of the most frustrating but potentially rewarding puzzles in trading: market liquidity. If you've ever felt like the market is literally out there actively hunting your stop loss, well, this explainer is absolutely going to change how you look at charts. Today, we're decoding market liquidity and testing exactly which market gaps are actually worth your hard-earned money. We're going to strip away all the noise and just look at the raw structural mechanics of exactly where institutional money is stepping in.
Okay, so let's just dive right into our playbook for today. We're going to kick things off with the order block trap, then we'll look at unhealthy price action. After that, we're running the FVG magnet test, figuring out the rules for validating the order block, and finally, we'll wrap up with the refinement test.
All right, part one, the order block trap. So you gotta ask yourself, are order blocks actually just retail traps? We map out these zones on our charts with absolute confidence, expecting them to act like impenetrable brick walls. But let's be real for a second. Do these zones truly act as magnets for price, drawing the market in for that perfect reversal? Or are they just empty, meaningless spaces on the chart, designed to catch retail traders totally off guard? I mean, you've probably heard the saying a million times, right? Order blocks are where the big banks leave their money. They get hyped up as the ultimate institutional footprint zones. But then reality hits. You set your pending order, you sit back, and boom. You just watch the market blast right through it like your zone wasn't even there. The reality is, while order blocks are a perfectly valid concept, playing them normally without the correct structural filter often results in getting completely crushed. They simply cannot stand on their own.
Which brings us to part two, unhealthy price action.
Now, there's a huge shift in mindset we need to make here. There's a profound contrast between what most people think they want to see and what we actually need to see. Take healthy price action, for example. Imagine a market that's just slowly, calmly grinding along. The candles are overlapping, the wicks are touching, everything looks very neat and orderly. But here's the secret: we don't want healthy. We actually want unhealthy price action. We're hunting for those moments of violent displacement. 2 or 3 massive candles that just skyrocket or completely tank in a split second, leaving huge imbalances behind. Basically, we want to see the market panic, because that aggression, that is our footprint. Okay, let's move to part 3, the FVG magnet test. So what exactly gets left behind after a violent move like that? Well, it creates a fair value gap, or an FVG. An FVG is simply an imbalance that happens when the price moves so unbelievably fast that the market didn't even have time to fill all the orders on the book. It literally leaves an empty space in the price delivery. And the core theory we're working with here is that these specific imbalances act like invisible high-powered magnets for future price action. The market is a super efficient machine. It hates empty space, and eventually it really wants to come back and rebalance it. So how do we actually spot a valid FVG? We use a strictly mechanical, step-by-step rule, the 3-candle rule. First, you find a strong move. Let's just say an uptrend. Second, mark the high of the first candle in your sequence. Third, mark the low of the third candle. And step 4, this is the most important part, you confirm there is a literal, visible gap between the high of candle 1 and the low of candle 3, where they absolutely do not touch. That empty space, that is your FVG. And hey, quick pro tip from our testing: the absolute best retail opportunities lie in the gaps that haven't been touched or mitigated yet. Fresh air is exactly what we want. All right, part 4, validating the order block. So here's the absolute crucial point where this all comes together. An order block is essentially the last selling candle before a big move up, or the last buying candle before a big move down. But here are our strict validation rules. That order block must be located right next to a fair value gap. If you look at your first and third candles and they just meet up with no gap, that order block is weak. It's a trap. Skip it entirely. And what if your primary order block is missing the gap? Our strict rule is to simply shift the zone to the next candle in the sequence that actually has an FVG attached to it. Simply put, an order block without a fair value gap is highly likely to be a retail trap. Don't fall for it. And finally, part 5, the refinement test. Okay, picture this. You find a massive, beautiful order block with an FVG on a 30-minute chart. The problem? The zone is huge. Your stop loss might have to be like 135 points wide, which is way too much risk to stomach. So here's a micro to macro process for you. You take that massive 30-minute zone and you zoom all the way down into the 5-minute or even the 1-minute chart. What you're hunting for now is a tiny, precise order block, completely nestled inside that larger macro zone, which also perfectly pairs with its own micro FVG. And this brilliantly illustrates the ultimate payoff: 20, Yep, just 20. By zooming in and finding that nested, perfectly valid order block and FVG pairing on the 1-minute chart, you are shrinking a massive 135-point stop-loss risk down to an incredibly tight 20 points. Your risk-to-reward ratio just went through the roof, all because you demanded structural proof on a lower time frame. Real game changer, right? So what is our final verdict after decoding all of this? The core takeaway here is that order blocks and fair value gaps cannot and honestly should not be traded in isolation. You absolutely need that unhealthy displacement to prove to you that the big players are actually in the market. The magnet effect is very real, for sure, but patience is your ultimate filter. You've got to wait for the definitive proof, that specific signature of big money entering the liquidity pool before you risk a single cent. To help you really master this system, I highly recommend downloading the free price action imbalance cheat sheet. The link is right there in the app. It's a seriously fantastic tool to help you practice visually identifying these gaps on live charts. And it goes into further detail on inside bar rules and the exact mechanics of shifting your order blocks when those gaps are missing. You're definitely going to want to grab that and keep it right next to your screen. Which leaves us with a final thought for today. As we get better at mastering internal market liquidity, we have to start looking at the outer boundaries. Are previous day highs actually the ultimate reversal points, or are they just massive pools of liquidity waiting to be hunted by the institutions? Kind of makes you think, right? Keep that in mind next time you pull up a daily chart. It's a totally fascinating concept, and it perfectly sets the stage for our upcoming liquidity hunt deep dive. Until then, keep your charts clean, stay disciplined with those gap validations, and I'll catch you in the next explainer.